Hey guys, Gareth here and welcome back to the Finance Fitness channel with my trusty advisor Nana. This channel is all about breaking down personal finance, making it easy to understand and accessible to everyone. Unless you studied finance, a lot of these important topics just don't get covered in school, yet we all have to deal with money matters on a daily basis. So if this is something that you're interested in, make sure you subscribe to the channel. Okay, so in this video, I'm going to look at what an ETF is, why it's become so popular, and which are the best ETFs for you to maybe invest in. Well, an ETF is a type of investment product that you can invest in, usually directly on the stock exchange or from the asset manager who runs that fund. Many ETFs are designed to track some sort of an index. So for example, the VOO from Vanguard is designed to track the composition and weightings of the S&P 500 index. And the S&P 500 is of course one of the main stock market indexes in the US. So when I say it will track or mirror that index, what does this mean? Well, the S&P 500 is an index composed of the 500 biggest companies in America. And these are weighted according to their size or market capitalization. So the ETF will invest in each of those 500 companies at exactly the same proportions as the index itself. And so if you take $1,000 and invest it in that ETF, you're actually getting a little bit of exposure to each of those 500 companies in that index. So what's great about this is you get a whole basket of stocks with just your single investment, instead of having to go out and buy each of those individual 500 companies at the right allocation and weightings. Another important thing to take into account is that an ETF is a passive investment. So here it just tries to copy the composition and weighting of an index or even several indexes. And that's different from an actively managed fund, like a traditional mutual fund, for example. With these actively managed funds, the portfolio manager picks stocks that they think will do really well and invests more in those stocks than the index would, and invests less in stocks that they don't think will perform so well. Well, earlier I spoke about active management, and this makes a lot of sense to people because you pay a professional to go out and pick stocks that they think will do better and avoid those that they think will do badly. But according to research done by Tony Robbins and his team of experts in this book, Money Master the Game, they found that only around 4% of investment managers are able to outperform their benchmarks over the longer term. Only 4%, and these are some of the smartest and brightest people in the investment world. And by the way, even though this book is really thick, it's filled with a lot of good stuff and I'd strongly recommend it, so I have included a link in the description if you're interested. So when you think about it, at 4% you have a 1 in 25 chance of selecting the right investment manager that will outperform their benchmark. And really what this shows is that maybe the pros don't get it right as often as we may think. And this is one of the reasons why a passive or ETF strategy has become so popular. Another reason why ETFs have become so popular is because they're really cost effective. In this book of Money Master the Game, from the research that Tony and his team did, they found that the average mutual fund has a total cost of around 3.2% every year. And this is actually much higher than I expected, because from what I've seen, I generally saw funds at around 1.5 to maybe 3.5%. But even if you take an average of that at around 2.5%, it's still really high charges. And now if you compare that to an ETF, you see that there's quite a big difference. For example, if you look at the most common stock market ETFs like VOO, maybe IVV, VTI, all of these funds have an expense ratio or total cost of less than 0.1% every year. So a traditional mutual fund costs around 25 times as much every year compared to an ETF. And even though it's 25 times more expensive, you only have a 4% chance that that fund will do better than the index itself. In fact, Warren Buffett, who is often considered the Oracle of Omaha and really considered by many people to be the greatest investor of our time, put his money where his mouth is. Because back in 2008, he took out a bet with a hedge fund that if he put his money into an ETF, in this case the VFIAX, it would outperform a hedge fund over a 10-year period. Now, if you're not familiar with what a hedge fund is, This is similar to a mutual fund, except that it's generally closed off to the public and targeted at high net worth individuals. These hedge funds typically use very sophisticated investment strategies. Now, Buffett did this to show that the average investor doesn't really get value for money for the fees that they pay for actively managed funds. The typical fee structure of a hedge fund is a 2% annual management fee plus a 20% profit share when they outperform their benchmarks. This compared to a 0.04% fee of the fund that Buffett invested in. And the total value of the bet was $1 million. And at the end, Warren Buffett's ETF had generated a cumulative return of over 85% compared to around 22% for the hedge fund. So it was not even close. And to further show the confidence that Warren Buffett has in ETFs, on several occasions he said that when he dies one day, he would want his wealth to be put into ETFs. Look, every day there are new ETFs and ETF providers popping up because this is a really rapidly growing area of financial services industry. But probably the biggest and most well-known providers are BlackRock and Vanguard. BlackRock is the biggest asset manager in the world, and they've got total assets under management of over $7.3 trillion. And as a reference, this is more than twice the size of the German GDP or annual economic output. BlackRock's ETFs fall under the iShares umbrella. Many consider Vanguard, with the founder Jack Bogle, to be the pioneer of the ETF concept, and it's grown to be one of the biggest, if not the biggest, ETF providers in the world, with a total assets under management of around $6.2 trillion. But aside from Vanguard and iShares, there are many other providers out there that also provide ETFs, like Schwab, Invesco, State Street, and Fidelity. And aside from all of the providers, there's also an endless list of different ETFs you can choose from stocks and bonds, international stocks, small cap stocks, large cap stocks, maybe gold or oil. There's so many ETFs for you to choose from. But I've narrowed that down for you, so here are a few ETFs that you may be interested in, split between different asset classes, and I've invested in most of these before. For US stocks, you have VOO, IVV, SCHB, and VTI. These are very common US stock market ETFs. If you want to look wider at an international market, we have ACWI, ACWI, EEM, VT, and VWO. And then when it comes to bonds, some of the most common ones are BND, BNDW for international, and AGG. Now, of course, you can do a mix of these different ETFs in order to achieve a diversified portfolio. But maybe you're unsure about how much you should be investing into each of these. I'll do future videos on this topic, but in the meantime, here's some options for you to consider. So balanced or mixed funds tend to be a bit more expensive at around 0.3 to 0.35%. But I really like them because they give you a great mix of assets and geographic exposures. It's all wrapped up into one fund. And these tend to be structured a lot like some of the big pension funds. But some of the funds that stand out to me are, for example, AOR or the slightly more aggressive one, AOA, both of them by iShares. Now, I know I mentioned a bunch of different names, so I've included a link in the description to each of the different funds that I mentioned in this video. I'll also be doing some deeper dives into some of these funds in future videos, so be sure to keep an eye out for that. Now, some of these funds may not be available in your country, but there may be similar ones that comply with your local regulations. And as always, guys, go speak to a financial advisor to make sure you find something that suits your needs and investment goals best. So have you been investing in ETFs? Maybe you've come across other ones that you find really interesting. Let me know in the comment section down below. I make sure to read and respond to every comment. You can also catch me and Nana on Instagram, and here's my handle. And that's it for the video today, guys. I hope you enjoyed it, and if you did, make sure you hit the like and subscribe buttons, please. It really gives the channel a huge boost and it means a lot. I'll see you next time.